Happy Friday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Friday, October 17th, 2025. Hope everyone's having a great week. So, as you know, we always start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So, today's key macro question is, should we be worried about the collapse in regional bank stocks? Our answer, in terms of answering the question above, our answer is a resounding no. We do not say this with conviction because we have any sort of analytical edge on the developing situation. We do not. Rather, we are not worried because the portfolios of the investors in our global Team 42 community are guided by KISS and Dr. Mo, which are institutional grade risk management overlays that listen to the market and respond to market developments better and faster than most investors, especially those relying solely upon fundamental research to manage risk. If you learn anything from me before I get hit by a bus or struck by a meteor, it should be the following three things. Number one, retail investors are squandering their competitive advantage relative to institutional investors by taking factor risk in their portfolios and thus should generally avoid doing so to achieve optimal results. Who do you think they're picking off when they're making their trades? Two, there are only six macro forces that impact asset classes on a trend basis. One, growth. Two, inflation. Three, monetary policy. Four, fiscal policy. Five, liquidity. And six, positioning. Not in that order. They're all equally important. Moreover, the positioning cycle is not a catalyst. Something must change on a durable basis in one or more of the other five cycles to durably alter the momentum and dispersion within and across asset classes. And number three, in a fourth turning, the distribution of probable economic, policy, and market outcomes is much wider than anyone currently investing has historically observed, which dramatically lowers the probability that investors can consistently manage risk effectively, relying upon fundamental research alone. Per our October 14th leadoff morning note, is it finally time for a healthy 5 to 8% pullback, or will asset markets devolve into a full-blown row phase transition soon? I don't know, and I don't live in fear of not knowing the answer because we know KISS and Dr. Mo have our backs because they are as optimized for minimizing downside capture in bear markets as they are for maximizing upside capture in bull markets. They are, however, not optimized for freaking out about 5 to 8% pullbacks in the S&P 500 or short-term liquidations in the crypto market. If successfully trading every wiggle in global financial markets is what you desire, then best of luck on your journey to retire on time and comfortably. You're going to need it. No change to anything I said on Wednesday. No change to anything I said on Thursday. And obviously, we're saying what we're saying here on Friday. So the key takeaway from this is when you get these sort of newsy headlines, this could be noise, this could be news. It seems like it's noise if you read the news flow. It's like tens of millions of dollars of defrauded loans in terms of the banks that are in question now. But it also could be signal because there's very clearly rising stress in the repo market, something we called out earlier this week. And so I don't know what the answer is. I'm not trading repo, but I tell you what, who knows what the answer is? KISS and Dr. Mo will figure out the answer way faster than I will as the architect of the Paradigm C 42 macro bull market. The 42 macro Paradigm C bull market, which began back in April. Of course, I still believe in that. That's my fundamental research view. I haven't seen anything from a fundamental standpoint that should alter the theme. However, that may be forthcoming. And by the time I get the fundamental research, the markets will have already moved. This is why we listen to the market with KISS and Dr. Mo and use KISS and Dr. Mo to guide our exposures, in our portfolios, because they move faster. They put our buy and sell orders in line ahead of the crowd so that we can sell what needs to be sold faster or buy what needs to be bought faster than the other investors who are going to have to performance chase in the weeks and months following us. Just exactly what we saw in Q1 heading into the crash. It's exactly what we saw in early Q2 heading into the recovery. And it may be what we're observing here and now. I'm not sure. I don't know. So, it's okay to say, I don't know. I don't have all the answers. We have a lot of answers, obviously, but I don't have all the answers and I don't lose sleep at night not having all the answers because, again, I know that we have Kiss and Dr. Mo to chop off the left tail of the distribution to help our portfolios avoid volatility drag in market crashes. Like I said earlier, 5 to 8% pullback in the S&P 500, I'm going to sleep. Don't wake me up for that. 20% crash in the S&P 500, yeah, let's chop off the left tail of the distribution so that we have more money to compound when the next bull market starts. It could start within weeks, just like it started in April. It could start in years, like from the top of the dot-com bubble to breaking out above the highs in early 2013. Like we don't know. We don't know the answer to that. So we can guess, we can speculate, but I'm telling you right now, if you're trying to use your puny little human brain, and myself, I consider myself included, my puny little human brain does not have the ability to manage risk effectively on a consistent basis throughout the duration of a fourth turning when the distribution of probable economic outcomes is as wide as anyone living has ever seen. Period. So this is the point I'm making. Like maybe in the first turning, we'll all be able to guess exactly where we are in the growth, inflation, monetary policy, fiscal policy, liquidity, and positioning cycles, like a lot of people used to. But I tell you right now, if that's what you're doing right now, I guarantee your results are a lot worse than those results that are being generated by Kiss and Dr. Mo. And I mince no words about that because we are having a fantastic year after having a fantastic year in 2024, after having a fantastic year in 2023, after having a fantastic year in 2022, and after having a pretty good year in 2021. So with that, I'll transition our 42 macro dashboard. We'll wrap up with a question from our community. This was not really a question, but it's something I thought was worth sharing. It's titled Double My Retirement Account. It says, hi, DD. I just passed to say a big thank you to you and 42 Macro team for all your hard work. Thank you. I subscribed to 42 Macro at the beginning of this year and twisted my retirement portfolio as per KISS and rebalanced it to keep as close as it was recommending. Since then, I almost doubled my retirement account and I'm holding the rest of my liquid assets as per your daily outlooks at KISS and Dr. Mo, and that's priceless. It filters out all the noise from mainstream and social media and gives me the clarity and certainty where we are and most probably where we are going. Thank you again, and God bless you. Thank you again, and God bless you as well, my friend. I appreciate the kind feedback. If you're an investment professional, if you're someone working in the financial services industry, this is what we're supposed to be doing. If you're not doing this, then reorient your career to doing this, because this is what we're supposed to be doing. Thank you. Have a great weekend. Cheers.